welcome to the ShareSoc webinar focus on Saba Capital, its actions and the implications for shareholders. Before we start, just the usual disclaimer that we're not touting any shares here. We're not giving specific advice. This is a discussion. It's an excellent panel that we've got here today, a discussion and Q&A, but before taking any decisions, investors should take the appropriate advice or do the appropriate research. We're going to start with attendee poll. Pavlina, if you would like to put the poll up, please. I'm going to let that sit there for a little while because we have quite a few attendees. I just want to make sure that everybody gets a chance to vote. So we have 40% of the audience invested in none of the 7, which is an interesting number. Did note that in the sign-ups for today's webinar, there's quite a lot of professionals in the market. So that presumably is where that body comes from, and a good spread, including quite a few Herald investors, which is interesting since the Herald vote was passed on, was turned down on Wednesday, which is good news. Welcome all. Thank you very much, Pavlina. So today we have a panel session. As I said, we have an eminent audience, which I'm very grateful to our guests for coming. Hopefully they have a good overview and hopefully an objective overview of what's going on in the market. I'd like to sort of break it down into, is there an issue? Generally when there's shareholder activism, it suggests that there's a problem. So the question is, what do they have a point? Does Saba Capital have something? Are they telling us something we need to be aware of? What issues does it raise for the sector, in particular for the boards of trusts? What are the considerations that investors should take on before voting, and why it's important for you to vote? We'll have a Q&A at the end of it, although, as I said, I'm happy to take questions on the way through as well. And then we'll move to a presentation from Mark Bentley, who's a ShareSoc director, on shareholder rights and voting, how to vote, why it matters, and so on and so forth. My panel, and I'd like to ask them to open up their videos as I introduce them. Or all together, I don't mind. Baroness Ros Altman should be known to all of you, former pensions minister and investment director. She has been doing fantastic work along with Baroness Sharon Bowles and along with Ben Conway of Hawksmoor, really to promote the investment trust sector and to look at hurdles that the sector is facing, in particular the PRIPS required cost disclosures, which have been an absolute disaster and which have resulted in very spurious and very erroneous messaging from the sector to investors, which we collectively, I think, or at least we at ShareSoc collectively, believe are part of the reasons for the discounts that we've seen across the investment trust sector in the past couple of years. There's been some great strides forward on that front. And Ros is a great commentator and a great supporter of the investment trust sector. Next, I have James Carthew, who's co-founder of Quoted Data and head of investment company research for the company, and who has taken a very strong interest in what's going on with the Saba attack and has written extensively about it. I move to Richard Stone, who you will also all know, CEO of the Association of Investment Companies, the AIC, and he was also the chief executive of Share PLC, which is the platform associated with the Share Centre. Strong interest in governance issues and in shareholder rights. And finally, Jeff Prestridge, again, hopefully known to all of you, personal finance editor, Mail on Sunday, big fan of transparency and clarity for retail investors, and we're hoping to hear his insights today as well. Thank you. I'm going to now ask Pavlina to remove the slides and to put, not ShareSoc, but can we put all of us on the screen together? I'm going to let Pavlina struggle with getting us all on the screen together. I don't want the ShareSoc logo to be taking front and center, but while we do that, we'll start the process. So I guess the first thing is, what has happened. We've had 3 years of substantial discounts in the investment trust sector. There are a bunch of reasons for that, but nevertheless, it's problematic. It means for investors in funds which are performing, being locked in is not that much of an issue. But for investors in funds or in trusts that are not performing, there's a degree of frustration that is created. That frustration over time turns itself into an opportunity for activists. And we have seen over the last couple of years a change in the shareholder registers as activists have moved in and taken camp. And now we've seen they've played, in the case of Saba Capital, their hand. Saba Capital owns a chunk of some 35 trusts that is targeted in its initial attack, 7 trusts. Its claim is twofold. Its claim is that, interestingly, the boards haven't held the managers to account for the discounts, but I'm not sure that the discounts and discount management is really an investment manager issue. That is primarily a board issue. So I think there's an error in the attack there, but nevertheless, they're pointing to those discounts. And secondly, they're pointing to performance issues. And I think it's fair to say I've done quite extensive review of the performance of these trusts. That it's not that second accusation is not particularly fair in the case of at least 3 of the trusts, and so there's a degree of opportunism about the attack. But in some of the others, there's perhaps a little more of a point to it. But the real question is, what has the sector done about it? What have the boards done about it? Have they been on their game? Does Saba Capital have a point? And I'm going to open to Ros first, if I may. And Pavlina, I do need to have Ros highlighted, please. Ros, over to you.
I'll carry on anyway. I think Saba have picked up on a dysfunction in the UK market, especially when it comes to investment trusts. And as an opportunistic investor and a short-term trader, they clearly spotted an opportunity and have tried to maximize it. The point they have is that there have been big discounts, and that can be an issue for a short-term shareholder. The point that they've missed, in my view, is that UK investment trusts were never supposed to be short-term trading vehicles. They're long-term investments for retail or small institutional investors who which give a diversified array of opportunities for them to hold a portfolio. The shareholder protections in these investment trusts, particularly, as ShareSoc has pointed out before, are not strong enough, and Saba have therefore capitalized on that and trying to seize control without a majority stake.
Thank you. And James, do we have a problem?
I think there are some problems. I mean, one of the ones is that Ros, as you've already referred to, is about the cost disclosure issue that has meant that a raft of professional investors have either not been buying or actively selling investment companies, and that's driven out discounts on alternative assets in particular, although these are not the ones that the Saba has been targeting. But generally with the wealth managers, you've also seen a lot of consolidation, and that has meant that they're sort of getting to be too big to invest in investment companies. They kept turning around and going, it needs to be at least 100 million, it needs to be 200 million, 400 million, 500 million, a billion. And there is a point at which the mega wealth managers just don't use them anymore. So they're all net sellers, and that's slightly frustrating. And then coupled with all of that, you've had the general kind of fallout of markets from rising interest rates. So from really, I suppose, at the end of 2021 going into 2022 and onwards, things that had done well in an environment of ultra low interest rates did less well, and particularly growth stocks, which and many of these have been targeted. And the other sector that fell out of favour was small cap, and small cap again is another thing that Saba has targeted. And so this has given it the opportunity, I think.
Yeah, I mean, I think the lever, if a lever exists, is that concurrence of poor performance and discount. We are talking about a sector which is high conviction, high concentration. It's on purpose that way, and that's the whole point of permanent capital. Yeah. is to allow the management team the freedom to express themselves without fear of having to run liquidity and without fear of redemptions in the short term. But at the same time, I do think that the combination of poor performance, which is the case in some of the trusts, with discount, does create a frustration that kind of needs to be on the radar of the relevant trust. Richard, your thoughts, please.
Yeah, thank you, Mark. I mean, I think if there's a problem, I would frame it as well in the context of a broader issue for UK equities. I mean, I think if you look at data from the open-ended sector, they've had 41 months of outflows out of the last 42 or something. You know, that level of outflows and the sucking of capital across into the mega seven in America, etc. You know, the investment company, the closed-end fund sector is not immune from that. In the open-ended sector, it's redemptions and the funds shrink. In the closed-ended sector, it's selling pressure, and that causes discounts to widen, etc. So I think one of the things I would mention, though, going back to your very original question, was you know, the implication or any implication that boards are sitting there idly watching these discounts and not doing anything about it is something for the birds, I think. I mean, the sector and their boards have been incredibly active over the last 12 months. We've seen record levels of share buybacks approaching 8 billion last year, which was way ahead of the record of 3.9 billion, which was set the year before. We've seen record levels of mergers between trusts, partly addressing James's point around size. So we've seen 10 mergers in the last year, which was double the previous annual record. Included obviously the merger of Alliance and Witten, which then went into the FTSE 100 as the fifth investment company now in the FTSE 100. We've seen a handful of manager switches. We've seen, I think, over 30 fee changes to the benefit of shareholders. You know, the idea that boards are sitting there idle and not deploying a pretty full range of tools to address some of this is simply not the case. Boards have been incredibly active, and you can see that in terms of what's been going on in the last 12 months.
Thank you. And Jeff, your media perspective, please.
Well, I mean, I agree with everything that's been said so far. I mean, I think investment trusts, as Ros so beautifully put, they are there for people to invest in the long term. And of course, Saba is being opportunistic. It's done nothing wrong. I can see where it's coming from. It doesn't mean at all that I support what it's doing. I don't think it's in anyone's, or certainly in no investor's best interests to support what they're doing. And we've seen the kind of shareholder response to it already at Herald Investment Trust. I do think there is a communication problem that hasn't been mentioned by any of my fellow panelists. I think what has happened, and it applies also to open-ended investment funds as well as investment trusts. I think there is a disconnect that exists now between shareholders and the investment trusts themselves, and that is really a function of the role that investment platforms now play in this country. Now they brought, great they brought great advantages to investors in the form of easy trading. You're able to see the value of your investments quickly online, as near as damn it in real time. But I think because they're the kind of mediators between the shareholders and the investment trusts, there's a disconnect. And I don't think that the investing platforms have actually done enough to kind of fill that void. And we've seen that with some of the platforms and the way in which they communicate general meetings of the form that Saba has demanded and got. That information, I don't think, has then been relayed back to the users of their platforms effectively enough. And also, I don't think investment trusts do enough to ensure that their shareholders, through the platforms, get information about themselves. I think they need to reconnect with their shareholders far more than they currently do. And I've seen some of the platforms facilitate that. And I'm a shareholder in one trust where I have been able through my platform to click for information, regular information from that investment trust and the managers about what they're doing. I mean, boards. I think buybacks are brilliant. I'm not quite sure whether most shareholders really understand what buybacks mean for them. But I think that there's a communication void, and that needs to be filled. And I think investment trusts need to do a bit more, and investing platforms need to do a lot more. They create great revenues from their role, but they need to give back a bit more. It's not good enough just to have best buy lists. I think they need to do more to act as to facilitate communication between the trusts and the end users, the shareholders.
Thank you, Jeff. That's straight into the ShareSoc playbook, so for which thank you very much. We have a huge amount of effort focused on really the law behind the role of nominees in intermediating between beneficial owners, ultimate beneficial owners of stocks generally, but investment trusts in this case, and the companies that they own. And we're doing a huge amount of work lobbying Sir Douglas Flint, Mark Austin, the Digitisation Task Force, who are focused on trying to ensure that we as a country take advantage of the digital advances that have happened, to ensure that the platforms do act as proper intermediaries and do take all of the information. It's ultimately ridiculous that companies and investment trusts are required to produce a massive amount of information. They're required to send that information to their members. Their members are direct shareholders, and following dematerialization, broadly intermediated holders through nominee accounts. There is nothing forcing that information to go through the nominee accounts. It's entirely at the choice of the nominee, and in general, it doesn't make its way through. There are exceptions, as you've mentioned. We've noticed particularly II and AJ Bell have made great strides in this, and there will be others alongside. But looking at this particular case, it's been interesting. There was a set of questions yesterday about the Lloyd's owned platforms, and their decision to deem what's going on here as not a corporate action, and therefore not to pass the information through to their shareholders. There should be no right. I mean, first of all, right or no right. Common sense means pass it through, but it should be absolutely not be at the behest of the choice of an intermediary as to whether to do that. So this is hugely important stuff. It's hugely critical right now because Sir Douglas has yet to come out with the task force's conclusions as to how we go about dematerialization, and we are hoping for a minimum service level which will be obligatory, which will at least ensure that all that information which is required by law to be produced at least reaches its intended target and opens up that communication that we've been speaking to. This is a slight red herring, I think, but I'm going to bring Richard in because I know this is an area that is close to your heart, if I may.
Thank you, Mark. I was itching to get in. The fundamental issue, without getting too technical, is that Part 9 of the Companies Act 2006 was on the basis of those intermediaries may pass the information through rather than they must pass the information through, and that's where the flaw fundamentally goes back to. I mean, I have to say, in this instance, our view is that actually there's a relatively new piece of regulation called the Consumer Duty, which places an obligation on platforms to make sure that their customers understand the products in which they are invested. And I wrote to the CEOs of all the major platforms, as well as to the FCA, to say that in our view, under the Consumer Duty, because of the fundamental nature of what Saba were proposing, not necessarily in their immediate resolutions, but certainly in the expressed intent as to what they would do subsequently, would have such a fundamental change to the underlying investment that the investor had selected. The investor needed to know about this. And I have to say, I will qualify this in a minute, but the major platforms certainly have responded to that very well. And you picked up II, AJ Bell, HL, Halifax Share Dealing, others. I know they've all written to their customers, regardless of whether they were opted in for shareholder rights, and they've highlighted these votes. And on most of those platforms, the ability to vote is relatively straightforward, debate relatively, but relatively straightforward. That is not to say that there isn't a tail of behavior that we've seen by some platforms. Some do not pass through voting rights, and I've actually seen it written into terms and conditions that they do not pass through proxy voting rights. I've seen some platforms who charge investors for voting. And I think here, although we're focused on the retail space specifically, I've actually seen examples in the advised and wealth managed space where the advisors and wealth managers use platforms, not the IIs and AJ Bells and Hargreaves of this world, but advisor platforms to hold their investors' shares on. And those platforms either not passing through the voting rights or charging significant amounts of money, which make it uneconomic for the wealth manager or the advisor to vote their underlying clients' shares. All of that practice is frankly outrageous. I mean, you should not be in any way prohibited from voting your shares. You should be given that information, and you should be able to vote your shares without any kind of encumbrance, whether that's hurdles in the way or charges or anything else. And frankly, having run a platform myself, the marginal cost of offering voting to shareholders is minimal because it can all be done electronically these days, and from the platform's point of view, they can submit it all through Crest, which is the sort of settlement system and stuff. It's all very easy to do electronically. So there is no real excuse as to why this is not passed on.
But surely now then is the time for the FCA to step up to the mark.
Absolutely.
Yeah, and the FCA have told me they've written to all of the major platforms to find out what they're doing to make sure their customers are aware and informed. I think part of the issue, so you're right, and I agree with you. I think part of the issue as well is we do need a legislative change that imposes the obligation that this information has to pass through. I mean, II is an interesting interactive investor, is an interesting example. So they moved all of their customers to be opted in for what are called shareholder rights. Rather than, and you can choose to opt out if as a customer you do decide that you don't want to in any way participate, whatever, and you don't want all the emails, you can opt out. And they've seen a significant increase in the level of engagement as a consequence. Most of the other platforms, it's a question of opting in, so you as the shareholder have to choose to do that. I mean, I would argue that the default should be that you're opted in at a very minimum as a starting point.
How can you possibly justify that in the background of Consumer Duty now? I mean, we have these new rules that would automatically, to anyone who looks from the outside and has some kind of basic thought about what's going on here, would say the rules are there, they're just not actually implementing them. And by the time the FCA writes to ask what they're doing, the meetings will be over before they get.
Oh, they've already done that, Ross, as
anything.
far as I'm aware. They've already done it. So,
yeah, but the meetings are coming up now.
Pressure.
I think the issue with the Consumer Duty is that it involves interpretation. What you mentioned with the Companies Act Section 9, a change in Section 9 removes any interpretation and simply means that there is no distinction in terms of the information rights and the voting rights as between an intermediated investor and a non-intermediated. And I think we need to get there. The Consumer Duty is a great tool for persuasion, but I think we need more than persuasion. I think we need coercion. 2 points that you made there that are, I think, fundamental. One is, and this is for Sir Douglas's ears, that the marginal cost of providing all of this on a digital platform is near zero. That's been a pushback that we received from Sir Douglas, and it doesn't, to my mind, hold water. And the second is the opt-in. It's fundamental that the default position should be that you receive the information that is prepared for you, and you get all of the opportunities and rights that are associated with that information, unless you actively say, I don't want it. There's nothing wrong with actively saying I don't want it, but it should be a decisive action, and ideally should be a decisive action at the holding level rather than at the account.
And playing into that digitization piece, Mark, I mean, bear in mind that when platforms first came about and this was being talked about, we've moved on a long way in terms of digital capability, but also the digitization of all the documents and everything else. So, to have an account with one of these platforms, you have to have an email account. All the documents are available electronically. So you're not talking about the cost of printing and the cost of postage and everything else, which historically would have been the case. So as I said, it's easy and simple to do and to provide that information. It doesn't need to be costly or onerous on anybody.
Good. I don't want to go too far down a rabbit hole on this one, but I do think it's relevant because this is part of the Saba playbook. The lack of information results in a lack of voting interest, and that voting interest, whether it's through apathy or whether it's through inefficiencies in the intermediation system or a combination of both, means that although Saba owns 30% of the holdings, if the voters don't turn out and make their voice heard, they effectively have the ability to control meetings and push through resolutions. The intriguing thing is that the Herald Trust meeting, which took place this week, there was some 86% voter turnout, which is unheard of, I think, for an investment trust. And that 99.15% odd of the non-Saba votes were cast against the resolutions. So it is interesting that in this case, the investors have been mobilised. Admittedly, Herald has a larger institutional share base than some of the other trusts that are here. So it's going to be interesting watching that dynamic as we go through it. It's going to be interesting watching the different votes as we go through. I would say that I think part of the reason why many of those platforms have passed the information to their shareholders, some of them incidentally too late for the Herald meeting, is largely because of your efforts, Richard, in persuading them to do so. I think without that wouldn't have happened. And I think also it's worth mentioning there's been a huge amount of cost on the part of the trusts, particularly Baillie Gifford, in publicising the importance of voting and so on and so forth. So the mobilisation has worked in this case. So the scenario that we're painting of inability of shareholders to know what's going on and to exercise their votes has not taken place in the Herald Trust, but it doesn't stop it from being a real issue. So I'm going to.
Can I just interrupt there, because I think you're missing one other party that has been quite brilliant in alerting shareholders to the need to vote against these proposals, these
media.
wicked proposals put forward by Saba. The media, exactly
Media,
right.
absolutely.
And, you know, it's quite disrespectful to have this conversation without mentioning the media. There's been some brilliant coverage by my colleagues on the Daily Mail, Alex Prummer, Callum Muirhead, and also some of the columnists in the Times, for example. They've written quite brilliant pieces. So please don't underplay our role.
You're absolutely right, Jeff.
I was going to make exactly that same point. It's not just about getting the platforms to send out the information, because you can send out all the information you like. The shareholders have to be woken up to actually reading and understanding the issues, and the media and the press have done a fabulous job at doing that. Both, as you say, Jeff, the sort of national press that you've referred to, but also the trade press, you know, the likes of Investment Week and places like that as well. It's been pretty wall to wall on this, and for which we as an industry are extremely grateful.
Yeah, and it has been one way. I don't think I've seen anything that has vaguely given credence to what Saba is doing.
And it was very helpful to have the proxy advisors, so Glass Lewis,
Yes,
ISS, come
exactly.
out and say that they were voting against, and to have some of the larger wealth managers make their positions public, which they didn't have to do, the likes of Evelyn Partners, Quilter, Cheviot, etc. So I think that's been very helpful as well.
Thank you, Jeff. And the reason why you're on the panel is actually in recognition of the media involvement in this process. And we did invite Alex as well to come and join us, as we did Ian Cowie. So we're fully cognizant of that. And actually, it's been really useful in getting some of the ShareSoc quotes out there as well. So. Our next point was, what issues does the attack raise for the sector? And I think, James, that's probably one for you, if I may. And I'm going to take a look at the Q&A on the way through this. So
yeah. So obviously we took a big there's a huge thing about mobilizing shareholders and the need for shareholder communication. We talked about all this already, and I think that needs to improve going forward. And boards communicating what they're doing with the discounts and where they'd like them to be. One of the things that I would like to be more explicit is more boards saying, we think our discount should be X, and we're going to try and aim for that sort of level. Most boards are quite wary of doing that, but I think there's no good reason why, if you've got a liquid portfolio, you shouldn't trade at low single-digit discounts. And if you've got a small cap portfolio, you shouldn't trade sort of around 10%-ish. And there's nothing to stop you trying to target that. I think more thought needs to be given to the possibility of regular liquidity events, but I don't think they should be too regular. So just to sort of let out those investors that are feeling frustrated that they don't want to be there anymore, but this periodic thing, not a regular thing. But as Rich has already alluded to, there's been an awful lot of soul searching and big sort of strategic thinking going on at boards about what they should be doing, and there's been quite a lot of action already. So I don't think we should criticize them too much. Things are moving in the right direction, and I'm quite encouraged that when we get past this, we'll be in a much better shape than we were. Now, there is a problem that Saba's created in that it's sort of backed itself into all sorts of corners. It's going to have an awful, tricky job to do to try and extract itself again. And the most obvious one, because we've got the result now with Herald, it seems impossible to me that it can now force anything to happen at Herald. You can't come back and put the same requisition in again. It could try and block continuation at the AGM in April, and we need to make sure that shareholders don't let that happen. You need to get out and vote again at the AGMs. But those shares will need to be placed, and I think that's going to provide opportunities perhaps to buy these things at discounts again, and investors need to be alive to those opportunities and ready to jump in and take advantage of some of the selling that Saba is going to be doing. I really hope they do lose everything. I hope if they lose all 7, that they'll retreat from the sector as a whole. But we'll just have to wait and see on that. What I can't imagine happening is that it actually ends up with a viable investment company that it controls. I can't see why investors want to stick around. But we're just going to have to wait and see on that.
Well,
Thank you.
the reason would be that retail investors don't turn out in force to prevent it from happening.
Well, yeah, but even if they end up controlling one, if, and this is a big if, as they've suggested, they provide people with a cash exit opportunity, I think most people will take the cash box rather than stay invested in something with a sort of dubious future.
Sure, but the risk, of course, there is that the assets which were meant to be held for the long term will end up being sold at knockdown prices, and Saba can benefit from that too. So, you're still looking at a serious detriment to ordinary shareholder interests and a specific advantage potentially to one minority shareholder who can just scoop the pool and is trying to do so, taking advantage of weaknesses that I think, we need to close off if we're going to have a proper shareholder democracy and proper shareholder protection.
Yeah, I agree. There's been some talk, though, about whether the takeover panel rules need to be changed, or whether something in companies' law needs to be changed, whether voting rights need to be restricted. I'd be extremely wary about going down any of those routes. I think that it's much more important that, as we've talked about already, that we actually just make voting easier and get shareholders to be engaged with the things that they hold. And then 30% is a perfectly reasonable limit. And,
I think there's a sort of higher level issue here, which is that activism is not necessarily a bad thing. We've seen multiple activist attacks on investment trusts over the years, mostly with a view of closing a discount. Very often those have been successful, and very often those have been aligned with the interests of other shareholders. I think the issue here is from a government's perspective, this then takes that process a step further. It's not just looking at closing the discount, it's not looking at closing the trusts if they don't make sense, it's not looking at partial closures, it's looking at handing the investment mandate to an organisation which is essentially the same organisation that controls the voting shares, and that, from a governance perspective, is producing a lot of concern. But before we move on to the considerations for investors, my highest upvoted question is, setting aside Saba's moves, I want to ask what the panel can tell on why UK investment trusts suffer from long and deep discount, and what is the future of this investment vehicle if it continues like this? I think that's a fair question to have a quick run through on. Ros, would you like to fire up?
Sure. I mean, I think the thing that those of us who have been trying to point out the detriment of the cost disclosure issue and the forced selling that brought forward leading to these discounts is that the sector is currently under existential threat. I don't think I can put it any other way. There is a serious question mark over how the UK financial markets, treat closed-ended companies relative to some of their perhaps perceived competitors, although there is no competitor. There's no other way that an ordinary investor could build sustainable investments in wind farms and so on in a diversified portfolio managed by experts, or indeed, real estate and so on. There is no other vehicle for that, and it's ideal for long-term illiquid holdings. The irony is, just as the government is trying to encourage pension funds and other investors to invest in these, there is a threat to their existence, which could lead to the sector, if you like, being taken out in some way and replaced by open-ended funds, which are not suitable, in my view, for this kind of long-term illiquid patient capital holding which is so important if we're going to boost growth in the economy, and is also, you know, a very, very smart way for pension funds to invest for the long term and get diversified array of returns from real assets, as well as just investing in a portfolio of equities themselves.
Totally agree. I mean, I think there's a couple of things. One of the trusts is offering its shareholders the opportunity to effectively wind up the permanent capital vehicle and move into an open-ended vehicle to express the same or similar strategy, which is, I think, a dangerous precedent.
I agree.
We haven't learnt the issues around liquidity from the likes of Woodford and so on and so forth.
Exactly.
We've got the FCA's answer, which is LTAFs, which is brings its own dangers and does provide competition to the IT sector. And the question is very valid. There are some existential questions around the sector, which to my mind is a jewel in the crown of the UK stock market, and is actually something that many other stock markets should aspire to. Permanent capital has extreme value, and that needs to be understood.
Can I just add though?
Who would like to come in?
I was just going to say, I think the bits that I would add to that is, if you've got a regulator that's telling us that we should be focusing more on value rather than on cost, more on consumer outcomes and investor outcomes, then, you know, the investment company structure, that permanent capital structure, closed-ended structure, is proven to have structural advantages which enable it to have the potential to deliver superior investor performance in equities mandates, as well as in some of those less liquid assets. So that's one other aspect. And then the other thing I would say is, if you look at the government's agenda on growth and investment, and you combine that with the fact that we've seen a fundamental shrinking in the size of the listed market. You know, I think the number of listed companies now is half what it was at the time of the general financial crisis, global financial crisis. You know, returns and capital have been concentrated into private assets, and we want more investment in infrastructure, etc. The only way you can meaningfully and reliably bridge the gap between public equity and private markets or private assets is through the investment company structure. And that's exactly, as Ros was saying, it's the perfect structure for doing that. It's the only reliable structure from an investor perspective, because you don't have that liquidity mismatch for doing that. So on the basis of both investor outcomes and the need to bridge the gap between public and private equity, I would argue that now is precisely the right time. We should be, you know, really standing behind this sector and jumping up and down about how marvelous it is. And actually, I have a number of conversations with people overseas who make the point that they don't have an investment company sector. They don't really understand it, but when you explain it to them, they sort of, well, why haven't we got some of these? You know, because they are excellent vehicles. Sorry, I cut across Jeff, so apologies.
No, you didn't. I don't think I was going to interrupt.
No, it was me. So the point I wanted to make was that I don't think, to sort of answer the question, I don't think it's a natural state of the investment companies market to be always trading at asset value. And I don't think that's something we should be aiming for. The closed-end structure is ideal for illiquid assets. It's ideal for taking a long-term view. It's a fixed pool of capital, that's the point. And the discount is the kind of pressure valve that it opens up when sentiment turns against that investment strategy for a short term, and then closes again when sentiment turns back again. And it's sort of a normal thing. I mean, there are acceptable ranges for discounts, but you can't really have a closed-end fund industry without some discounts being there.
Well, the problem we've got right now in the whole sector is that because of the extent of the discounts that have opened up, they can't raise new capital. They've got to use the existing capital to buy back shares if they want to narrow the discount. And that means, again, that you know, that the economy has been starved of an estimated 50 to 60 billion pounds of potential new long-term investment in infrastructure and housing and sustainable growth and small businesses that could have been supported by the strong domestic support base that these investment companies have had in the past, and should be building up, I think, from, you know, new pension funds going in there too. The idea that this sector might not actually be in existence in the way we understand it in the future seems to me to be completely against the aims of what both the economy needs, what the government is aiming for, and what retail investors can't otherwise participate in this way. If you're in an open-ended fund and lots of people want to sell, then the best investments, we saw it with Woodford, you know, they have to be liquidated because you have to sell at a certain, you know, market price that may not persist into the future. In the closed-ended world, the market sets the price, and lots of retail investors who've seen discounts before in these kind of difficult macro conditions have benefited very much from buying when others are selling, and the discount is there.
This is the fundamental issue that the industry hasn't managed to solve, which is how do you scale? Because a lot of trusts spend a lot of time sitting at a discount, and there hasn't been developed, I think I may be corrected on this, a sensible process for managing to scale a process while scale a pool of capital whilst it's sitting at a discount. It is an opportunity. You would think it was an attractive opportunity, particularly with the activity going on from activists to close discounts. You would think it was a doubly attractive area. Many of the comments, which, if I may, I'll tick off as addressed, relate to this. Well, surely it's an opportunity. I think like many things, it's a combination of opportunity and negative. I think a discount can be an opportunity. It can also be a statement of mistrust in a NAV. In some cases, it can be a statement of dissatisfaction with the manager. It can be a statement of costs and so on and so forth. There's a lot of things that go into that discount. I'm going to just address, because we're going to run out of time reasonably quickly, a couple of questions on here, really around Saba. Why isn't Saba involved in this discussion? We didn't actually invite Saba, but I do note that where Boaz has done his webinars, he's done it effectively solo, and he hasn't taken Q&A. I also note that although in his letter to shareholders he talks about wanting to, or his normal behavior being to engage with the trust he owns, but in this case he hasn't spoken to them at all. I think there's a degree of not wanting to communicate on the part of Saba, which I don't fully understand. But is a fair comment that one could have had Saba, or could have invited Saba onto this panel. Second thing about Saba,
Mark, and you should have invited them.
Fair comment.
You should have done. It's a bit of a one-way conversation here. We're all on the side, of the investment trust industry. In terms of balance, we should have had them represented on the panel, or they should have been, at the very least, been invited to comment and put their case forward. I call that democracy.
Fair comment. Yes, I like to think that there's a degree of objectivity here, because I think the subtext here is that there is an issue, and that issue does need to be dealt with, and that there is some value in activism. I think the issue we come across with Saba is primarily a governance issue rather than an activism issue. But yes, your fair comment that they haven't been offered the opportunity to state their case, and also the fact that Saga were able to build up such large stakes in several investment trusts fairly quickly seems to indicate a problem in itself. It implies a lot of shareholders who are willing to sell but unable to do so at a good price. Which is a point that Boaz makes quite frequently, and I think he has some justification in making that point. The industry is very heavily focused on buybacks and tenders and the likes, and a lot of the Saba rhetoric is around near NAV exits Those near NAV exits, of course, are now available because his company's activity has brought us to near zero discount, and at least in the trust that we're focused on at the moment. But I come back to this combination of underperformance and discount, and I think in that case it's a mistake to lock investors in. I don't think necessarily one needs to offer near NAV through winding up a fund, but one can do a partial wind up where effectively the fund is split into two. A series, the assets in the liquidation part of the fund are liquidated, and the cash is returned to the shareholders who vote to go into that process. What you'll get from an intelligent and commercially rational investor is yes, please, I'll take that, and I'll take the capital, and I'll recycle it back into the fund at a discount. So you're passing the benefit, if you like, to the investor rather than absorbing it in the fund, which is what the buyback does. It has issues. It makes the fund smaller. I mean, one of the problems we talked about is scale. Having amassed an amount of permanent capital, very few managers are keen on letting it go. But at the same time, trapping investors is a concern. Does anyone want to come back on that before I move on to considerations for investors?
Can I just come back in one respect, Mark, which is, and I think this is very Saba specific. I think, a typical activist, as you said, plays the discount, they buy at the discount, they see the closing of that discount, they exit their position, and they make their economic gain as a consequence. I think the issue here is much more one of control, and that's really laid bare with both Keystone Positive Change and now Henderson Opportunities Trust, which are offering shareholders a cash out at 99 and 100% of NAV, respectively. I think an interesting question is, why would you not support that as a discount playing activist investor? You surely would, under normal circumstances, support that return of capital and therefore the closing of the discount, much as we might lament that in terms of what it means for the sector or the shrinking of the sector, whatever, as a whole. It's returning capital to shareholders, as you say, at NAV after a period of relatively prolonged discounts. The fact that Saba are opposing or appear to be opposing those plans perhaps highlights that this isn't the typical activist play, and that there's more to this than just trying to close the discounts, because those two trusts have both answered the question as to how you can close the discount. And the other point not to overlook is just tying up with something else that was said earlier about the fact that the sector has a lot more alternative asset and illiquid asset investment companies. Buybacks, tender offers, etc., are much harder for those trusts to do, and to do on a sustained basis because of the nature of the underlying assets. So that sort of tool that we've seen used to good effect in many cases in terms of the equity type mandates where they have a liquid portfolio. And we've seen trusts, both buyback and issue as they've fluctuated around their NAV over time, and actually some grow as a consequence of doing that. In the alternative asset space, that's much harder because you can't sit behind a process of regular asset realizations and cash flow that therefore enables you to stand behind a sustained buyback. You can perhaps do a one-off if you have a realization, some spare cash, but actually sitting behind a sustained buyback program to close the discount is just much harder.
I also think that, one issue that we haven't really talked about is whether the sector would benefit from more mergers. And, if you look at the recent merger of Alliance and Witten, and you look at the discount that merged trust now sits at, I think it's something like 4%. It's part of the FTSE 100. I think we do need, I do think rationalization in terms of the number of trusts would actually make for a more effective industry as a whole. And what I love about Alliance Witten, and I know it's part of the FTSE 100, but it actually doesn't sit on its hands. It actually advertises its wares on the radio, on some TV on occasion. And I think that's quite brilliant. And I know, of course, there's loads of trusts that couldn't afford to do that. But, I think the industry needs to be more proactive rather than being so reactive. I think it really should champion, individual trusts should champion themselves more, rather than just sitting there almost waiting to be picked off by the Sabas of this world.
Thank you. I want to move on to considerations for investors. And there's a question from Sally McDonald at the top of the pile at the moment, which I think is a good start point. Saba are proposing flouting a wide range of UK governance laws with their proposal for two heavily overboarded, cross-boarded, conflicted people sitting on multiple boards. Consumer duty appears to preclude much of Saba's proposal too. Why have the LSE, the FCA, and other regulators not required Saba to change their proposals? If you can answer that on the way into considerations for investors, please. Jeff, do you want to start? Because you're sitting in the hot seat.
No, I think we've talked about whether the FCA, for example, should be doing more to protect shareholders' interests. I'd like to see the FCA be more punchy and react to some of the things some of the issues that Ros has mentioned earlier. I mean, I know there are hurdles. In some instances, legislation needs to be put in place. But I mean, I don't think we can sit. We can't stand still here. And I think the industry and the regulator, the industry needs to engage with the regulator far more.
Thank you. James, issues for considerations for investors on these votes.
Just on that point, there is a listing rule requirement that the boards of these things need to be independent, and the current two-person board as proposed wouldn't meet that requirement, and the FCA would step in then, presumably. But the Saba's proposing recruiting additional independent directors. I cannot get my head around how you've got two conflicted people already, how they're going to recruit non-conflicted people and then deliver up to Saba these management contracts. But the legislation is a bit fuzzy around here, and I think something needs to be clarified. I'd like to see some kind of statement, really.
If I could just jump in, I mean, this is another point that I included in my letter to Nicky Orati at the FCA on. So the issue here is the listing rules, as you say, James, are quite specific, that the board of an investment company has to be independent, but it specifies that that's independent of the asset manager. Obviously, at the point at which were Saba successful, at the point at which they are appointed, they are independent of the asset manager because Saba is not the asset manager at that point in time. So the issue is, could they get to the point where they have a position where they can then make the appointment of themselves as asset manager without breaching that rule? But you're then asking you're asking the FCA to intervene in a situation which is not currently in breach of the rule on the hypothesis of something that might happen in the future. I mean, I've absolutely no doubt that the FCA is more than aware of the issue and is watching it. Saba are, as you would expect, well-advised, intelligent people who are making sure that they stay within the 30% of the takeover code, are not breaching the listing rules as it currently stands. But how they would go about, I would agree with you wholeheartedly, how they go about getting from there to where their express intentions take them without at some point breaching the listing rules, and were they to breach them, what the implications of that would be from a regulatory intervention perspective. I mean, if a company breaches the listing rules, typically they're given an opportunity to remedy or rectify that breach. I'm not sure how you could rectify that breach in this case. And then ultimately the sanction is suspension or delisting, which obviously would have significant implications for any investors who are still left invested in that product at that point in time. So I think yeah, the issue is they're not doing anything. I think somebody said earlier on the call, they're not doing anything wrong at the moment. But how they get from here to there is difficult to see without falling foul of certainly the listing rules.
And then the other thing we should focus on is the fact that the proposals that they have made are quite woolly. So they've sort of alluded to the opportunity for cash exits. They've talked about strategy a bit like the one that they have with their closed-end fund in America. We don't know what the fees are going to be. We don't know what the terms of the cash exits would be or the timing of that. We just don't know enough about the proposed thing or even the track record of the proposed strategy that they've got to be able to make a reasonable judgment as to whether that's something you're actually attracted to. And for that reason alone, I think it's a good reason to say there's no way to support Saba, because you're just taking deep into the dark.
So the Saba proposal is effectively to fire the existing board, to fire the existing manager, to put in two new directors who then maybe become a larger group of investors, and to appoint Saba as a manager, and effectively, although it's not necessarily the case for all the funds, merge the funds and develop a super fund whose purpose is to arbitrage, to go out and buy other investment trusts at a discount, and so effectively bring the investors into an activist strategy. The group that is or that is driving the vote is intending to be represented on the board and also to appoint itself as manager, whilst holding sufficiently large element of the fund that they effectively have an outsized control over anything that goes on, and the ability to veto anything that looks like a resolution from third parties. Discuss, Ros, can I bring you in?
Yeah, I mean, it just keeps coming back to me, this question: who is protecting the shareholders? We are supposed to have a shareholder democracy and shareholder protection. This looks like a flagrant potential breach, which has been publicly stated as an intention. Flagrant disregard for normal rules of corporate governance, clear potential detriment to a minority, by a minority shareholder towards all the rest of the shareholders potentially, and who is meant to be stepping in to protect the integrity of the sector and the UK financial markets, which were supposed to be safe for retail investors to be part of. This would suggest that it is not safe, and I think there is a real urgency for official intervention here in the way that you would normally see on takeovers from the CMA, for example, on other situations, perhaps from the FCA. But it's just not clear to me that saying, well, once they achieved what they state they're going to achieve, they still won't be technically breaking any laws, and therefore they can do what they like to one of these long-standing success stories for the British financial sector. And it just seems to me that people should be jumping up and down a lot more, perhaps, than has been the case. And if it wasn't for the media, I think, to be honest, as Jeff said, a lot of the shareholders wouldn't even know what's going on before it hit them, and it was too late. So we shouldn't leave it in this way. There is real danger, not just for the narrow issue of these 7 trusts, but it's a much wider threat to our financial system and financial markets, in my view.
So a question that's been uploaded 5 times. Presumably the panel would have been less critical of Saba if it had stuck to pushing for discount controls as a shareholder activist rather than attempting to seize control. Can I just run quickly through the panel and have a yay or nay to that?
Yeah,
absolutely.
Yeah,
that's
completely.
the role of an activist investor.
Okay.
There are many other investors, Mark, out there in the market today doing just that. So yeah, and perfectly valid, normal part of the market operation.
Fantastic. And there's a sort of slightly related question. The Herald Trust vote has gone through, and we've seen the discount widen post that that negative vote from shareholders. And the question is, what now? I think the fundamental message is probably Saba hasn't gone away. They are going to close that discount one way or t'other. But does anyone have any views on that? Because I think when investors are voting for these things, they need to push the fast forward button and think, what happens if this gets through as proposed? What happens if it doesn't? Where's this going?
Well, if I was
What were the
Saba, I
things-
would be selling a lot of shares in Herald right now
Yeah.
to frighten other investors to vote for me. And I may be too cynical, but I think there may be an element of that.
Possibly. I mean, there is a short sellers appeared on Herald's register. So it's a different US hedge fund has popped up and sold the shares because it's not, I say it's not a natural state for them to trade at asset value. And they're already sitting on decent profit. If Saba decides it really can't get anywhere with this, I do think it will have to dump the stock. There is no other, I mean, it could hang around and wait for the Herald board to do something, but it's got no power to force that.
But I think fundamentally over a very short-term period, which is what we're talking here, a matter of a few days, the share price is fundamentally a function of supply and demand for the stock. And in the run-up to the Herald vote, Saba had been buying
Yeah.
stock very heavily. They'd actually bought, I think I'm right in saying, I might get the numbers slightly wrong, but I think I'm right in saying at the time that the meeting was requisitioned in December, they had 18.7% of the stock. By the time of the actual meeting happening earlier this week, they had 29.3%. So in the last month, they have bought effectively more than 10% of the company. That's a significant amount of demand for any company, would see its share price rise significantly as a consequence. When that buyer stops buying, and you add to that, as James says, the fact you've had a short seller coming in and other selling pressure on the market, then it's not surprising that that share price then falls back and you see that discount widen again. So the fact that Herald went to a premium and has then come back down to a discount, I would say says nothing about the underlying company or its assets.
Right.
What it talks about is the dynamics, and you can see it writ large in that short period of time, the dynamics between supply and demand for the stock, which is what drives the share price.
I also think that, I reckon it's about £130 million that Saba spent buying stock more or less at asset value, sometimes at a premium, with no hope of making actually a return on that £130 million for its clients, purely for the point of view of trying to seize control of that management contract and get their asset management revenues. To me, that just speaks volumes about why you don't want to be invested in a Saba-run fund of closed-end funds.
I think the other thing to bear in mind is that Saba doesn't just own these 7 trusts; it owns some 35 trusts, or stakes in some 35 trusts, and it's encamped. It's an intelligent investor. It isn't simply going to raise a white flag and go away. So I think we've got more to hear here. Jeff, do you want to come in on this?
Well, I think that's a very good point that you make. I don't think it's going to go away in a hurry. It will, let's hope, and I say that in the interests of, our nation of shareholders, that their proposals are voted down for each of the 6 remaining trusts that have general meetings coming up between now and the middle of February. But if there is a chink in those, if it's successful in one of those 6, then I think that will give it an appetite to launch similar or demand similar general meetings at some of the other trusts that it has stakes in. So I think really what we must hope and pray for, in the interests of the investment trust industry, the shareholders who have money tied up in the industry, let's hope that shareholders come out in force and vote against these proposals at all 6 trusts, because that will then, I'm sure, will kind of force Saba rethink its strategy.
I think this
You
is
know.
such a wide issue, Jeff, you know, that all other boards of investment trusts need to wake up straight away and start engaging with their investors, because this is not just, as I say, about these 7 trusts. It is a sector threat, in my view. You know, and you know, we've been trying to bang on about the threats and risks to the sector for the last 2 or 3 years, initially on the cost disclosure issue, which was definitely a factor. But that has now led, it seems to me, to this more fundamental problem, because even if cost disclosures are corrected and they look as if they might be at last, the damage has already been done. And unless we get more engagement from boards who understand, you know, the need not to act as we have been before, and encourage or engage with platforms to make sure that somebody is representing the company to its shareholders directly, because at the moment it's so indirect via the platform, we'll just potentially be going around this house again soon.
Which leads to another question. We've kind of moved naturally into the Q&A, and I'm going to draw a line under it fairly swiftly to allow Mark to do his bit. But there is a question that's top of the pile at the moment, which is, could the panel comment? And I think this is highly relevant, on the quality of the boards of investment trusts. Is there room for strengthening their composition and effectiveness? We haven't really covered this.
I think so.
Yeah,
I do. I really do. And I imagine Richard's going to take an opposite view to myself. But, you know, I think shareholder, you know, boards of investment trusts, I think the non-execs come from a very kind of small pool. And, you know, I'd like to see more dynamic boardrooms, you know, drawing from a wider pool of professionals. You know, it's almost as if there's a bit of a kind of drawbridge put up between the boards and the investors. I mean, I really want to see the quality of boards being raised, and maybe Richard will tell me that that's the quest of or the mission of the AIC, or that boards are okay at the moment. I'm not sure. I think we need new talent on boards, younger talent.
Go on, Richard.
Oh, we've certainly done a lot, and I would argue are doing a lot to broaden that pool of candidates, as Jeff refers to, and to encourage more people to become NEDs. I think the industry as a whole has done a lot more in terms of increasing diversity within the board, and I don't just mean by that, you know, gender and ethnic diversity and those sort of characteristics that get reported on in the annual report and accounts. I mean diversity of background. I mean, I do a sort of induction session for people who are appointed new to the sector, and the range of backgrounds that you're seeing, you know, from I can think of some recent examples, people who've worked in the energy industry going on to infrastructure boards, people who've worked in the healthcare sector going on to healthcare boards, you know, even to the point where, you know, GPs and things like that who've run health practices and stuff. So people with asset class specific experience, particularly in those alternative asset mandate investment companies. So we've definitely seen an increase in the diversity, a reduction in the average number of appointments held by each director, etc. So I would argue that, you know, I'm not suggesting that everything is perfect, but I would argue that the industry has made significant strides already in terms of trying to improve the range of diversity in terms of background and thinking that exists within boards. That doesn't mitigate the point that Ros made about needing to, you know, boards needing to do more in terms of communication and engagement with their shareholders and all those points, which I think is a kind of separate point. But there's definitely more that can be done there.
And that's what I think may need to be strengthened, perhaps, in terms of how you manage the issues around your share price, how you engage with investors and assess the mood of investors, if you like, more directly than has hitherto been the case. You know, just assuming that all your investors are going to be patiently waiting, as has typically been the case in the past, and it hasn't done most shareholders too much harm, because over the long term the sector has performed brilliantly. But you know, as it's clear, there are more opportunities for short-term interruptions, and little chance, unless things change, for you to urgently be in touch directly with your shareholder base. That's an element of board expertise and management that perhaps has been a little bit lacking.
I'm going to bring in a comment from the Q&A, which is on this subject, from Cliff Waite, who's a ShareSoc Policy Committee member. The fact that Saba has invested millions is because they spotted an opportunity for profit from trusts with discounts, with sleepy directors who've taken their eye off the ball. Like the hyena the activist preys on the weakest, it's a wake-up call for trusts that have not managed their shareholder base. They're fund managers who've been allowed to get rich from modest or below average performance. So it's I think a sort of, yeah, there's a wide disparity of views on quality of boards, but it's definitely an area of focus.
If I could just add one thing, which is a kind of exemplar of the issue that I'm alluding to. You know, people like myself and some of those in the industry, and certainly Baroness Sharon Bowles, have been desperately trying to help people understand that the cost disclosure issue was a major issue that would be one factor driving the discounts and could be corrected. It took 2 to 3 years, and there was almost there was some, but very little engagement from the boards of the companies themselves with us or with the group, or, as far as we are aware, directly writing to ministers and the FCA on the topic. And you know, it's been very difficult, because you know, I don't have a vested interest here. I'm just trying to do what is the right thing for shareholders, in my view, more widely. It's not a business interest that I have at all, but you know, from their perspective, it is a significant issue for the share price. So, you know, I think that is an area that we need to look carefully at in the sector.
Super. Can I ask for a 30-second a roundup rather, from each of the panelists? And can I, because we're on screen, Ros, can I start with you, please? Yeah,
well, the first thing I would say is anyone who's a shareholder in these trusts that haven't yet had their meeting, do get out and vote. The second thing I would urge is that we look very carefully and build on some of the work that ShareSoc has been doing and some of the media work that has been going on, to look at where there may be holes in the current shareholder protections, how we can tighten them up. And the third thing I would say is that we need everybody to realise quickly and appreciate quickly the difference between a hedge fund short-term trading opportunity and the fundamentally long-term patient capital investment approach that our economy urgently needs, and that could be so beneficial, particularly for pension investors who've got a long-term horizon and can stay invested in areas of our economy that desperately need investment.
Thank you, James.
Yeah, sort of echoing what Ros said. One of the messages that we've been striving to get across is that the sorts of uplifts that you're getting from a discount narrowing are tiny compared to the uplifts that you'll get if each of these investment strategies goes the normal investment cycle. When it turns and it comes good, things like commodities and tech and European small cap, when they come good, they can double, they can triple. And we're talking about comparing that with the sort of 5–10% discount narrowing. It's just not even a relevant thing. So please do get out and vote. Please make sure that you have your voice heard. But then going forward, if you've got an issue with a company and you are unhappy, communicate it. write to boards, turn up at AGMs, make your voice heard. That's the whole point. This is a democratic structure in a way that almost all other funds aren't. And boards do really care about what you think. Just, make your voice heard.
Thank you, Richard.
Yeah, I'll keep it very brief. I mean, we have to clearly do more in terms of shareholder engagement. I think the biggest flaw in the regulations as it currently stands, as to answer Rosie's point, is the fact that it's not an obligation on the platforms to pass through voting rights and to pass through even the information, and that cannot be right. And yeah, get out and vote. I think the Herald vote earlier this week was very encouraging. But don't see that as a complacency in terms of the other 6 trusts. If you're a shareholder in one of those other 6 trusts, get out and vote, and be aware of the deadline for voting on your particular platform, because it will be well in advance of the meetings themselves. So the meetings are the 3rd, 4th, 5th, and 14th of February. But for those on the 3rd, 4th, and 5th of February, the deadlines for voting are going to be towards the end of next week. So don't leave it for beyond another weekend. You may find you're too late.
Thank you. And we're not telling you which way to vote. We're simply saying it's important that you vote.
Yeah.
Jeff?
It's for shareholders to form their own conclusions, but get out there and vote.
Yeah.
Absolutely. I mean, I just, to all shareholders in these 6 trusts, they must go out and vote. I think it's an imperative. And then just longer term, I think we need far more investor engagement from the investment trust participants, from the individual trusts. I think the AIC, by the way, is a fantastic trade association and does far more to bat for the cause of investment trusts than its kind of fellow colleagues over at the Investment Management Association. So more engagement from individual trusts. Just really and far more from the investing platforms in terms of helping to ensure investment trust shareholders through their platforms are able to exercise their rights, and all information is communicated to them with regards to AGMs, EGMs, or general meetings.
Thank you. I'm going to close on a couple of points. The first one, there are some questions that I haven't got to, and apologies for anybody who posed those, but we have answered the high up vote questions. But a couple of them are saying, why are you so focused on bad Saba? And I don't think we are. I think the issue is the specifics of the Saba proposal as to what they want to do with these trusts afterwards. The initial focus on discount narrowing, on what's going on, there being an issue in the market, and that issue being ripe for activism. I think we're collectively on board with that. I think it's just the specifics of the proposal and the governance issues that those bring, which matter. Second point I was going to say is that the last bullet point on our agenda was why voting matters. I think we've covered that. There's a reliance on voter apathy. It's important that you are involved as a shareholder in the future of your trust. It's absolutely critical for you to get out there and vote. And rather than spending more time, I've been messages from Mark Bentley saying, please could you wrap up soon? People are starting to drop off and I want to get my messages out with that. Well, there's still a good audience. But with that, I'm going to thank my panel very much indeed. Fantastic session, very interesting. Very pleased that you were prepared to join us on this session. And I'm going to hand over to Mark. Thank you.
Thank you.
Thanks very much to Mark and the panel. I hope you found that an interesting discussion. The panel has highlighted the problems that trusts and other companies face communicating with individual shareholders and the problems that those shareholders have in voting. I will now deliver a short presentation explaining how that situation has arisen and what ShareSoc is doing to address it. I'll take any questions on my presentation at the end. So first of all, it's helpful to understand the history of share ownership. If we go back about 40 years, when you wanted to buy shares, you would go to your bank or broker hand over a check to them and tell them that you wanted to buy so many shares in whichever company you wanted to invest in. They would take your check, and after a few days you would get a share certificate issued to you. Your name would be entered on the share register of the company, and you were then a member of the company. Now, that was clearly a laborious paperwork process, and clearly as time has moved on, we need to move to a more digital process. To facilitate that, nominee accounts were introduced, and brokers and platforms nowadays manage the ownership of shares through nominee accounts. There are no share certificates issued. Your name is not on the share register, and only the nominee is a member of the company. So, as mentioned previously by the panel, it then becomes up to the platform or broker to exchange information bidirectionally between you and the company you're invested in. Next slide, please. So this interacts with the Companies Act 2006, which is the act currently in force. The act confers numerous rights on shareholders. So information rights and voting rights are amongst the most important, that you're entitled to receive the comprehensive information that I think Ros mentioned, and that you have a right to vote. But the Act only refers to members of the company. It's only in Part 9 of the Act, which was mentioned previously, that nominees have the ability to pass information onto the ultimate beneficial owners, i.e. the individual investors, and to take votes from those individual investors and feed them back into the general meeting process. However, as has been mentioned, that's very much optional as the legislation stands currently and not mandatory. And each platform takes a different approach to doing it. So that creates a huge loophole, which we're seeing Saba exploit now, that some nominee shareholders, individual investors, may not receive the information they ought to be getting from companies, and it's sometimes difficult to vote, or some platforms may make charges for voting. Next slide, please. So fundamentally, as the panel has emphasized, it's crucial that you vote. The AIC has published a very helpful guide on voting. You'll receive an email after this session, which includes this link here, but otherwise you can just search Google for AIC voting, and you'll find their guide, which details by all the major platforms what the procedure is in order to exercise your vote. Next slide, please. Thank you. So what's ShareSoc been doing about this? So we launched a campaign 10 years ago to address this issue. We've held numerous meetings with government officials, and substantive progress has been made. First of all, after a number of meetings with the Department of Business and Trade, that department commissioned a scoping study from the Law Commission to look into this issue, which we provided submissions to. And we're delighted to say that the Law Commission very much recognised our case and indicated that there needed to be legislative changes to ensure that individual investors were properly enfranchised. That was followed by the Austin Review, which the government commissioned principally to look at the issue of secondary share issuance by companies and how that could be enhanced to improve investment in the UK economy. But as part of the review, Mark Austin very much again stressed this issue, that it was important that individual investors were properly enfranchised, and it made a number of recommendations in that regard. Then the third thing that has happened is the government launched the so-called Digitisation Task Force, whose remit was to look at the share certificates that still exist. There's a few shareholders that do still hold shares in certificated form, which is clearly becoming an archaic mechanism. However, if share certificates are to be dispensed with, it's crucial that those shareholders don't lose any of their rights. And that was part of the terms of reference for the Digitisation Task Force flowing out of the Austin Review. We were very disappointed, however, that in the interim report from the Digitisation Task Force, led by Sir Douglas Flint, it didn't really seem to properly address those issues within its terms of reference. So we've met with Sir Douglas and the task force on a number of occasions since to press that point, and we're very hopeful that the final report does address the issues that we're concerned about. As Richard has suggested, part of the solution would be to make it mandatory for platforms to pass on circulars from companies to the end investors, and to make it easy for those end investors to vote. But that doesn't address all the rights that the Companies Act provides to shareholders. So we are actually looking for something broader. And if we don't see sufficient response from the Digitisation Task Force, we will continue to press this using the good offices of the press, such as Jeff and his colleagues, and in Parliament and so on, to end up finally with what we're looking for there. Next slide, please. So finally, in order to do that work, the directors of ShareSoc, like myself, Mark Northway, etc., we're unpaid volunteers, but we do need a team of staff behind us to be able to put on events like this, to be effective, to get our messages through to the press. So if you'd like to see us do that, then please support us. A very simple thing you can do is to join our shareholder rights campaign. Just go to representation on our website and you'll see the shareholder rights campaign at the top of the list. You can easily join it. And also please become a full member of ShareSoc or donate. Full membership costs only £57.50 per annum currently, which will enable us to do this work and lots of other work that ShareSoc does besides. And Mark Northway in a moment will describe a few more of the benefits you get from being a full member. So thanks very much for your time. And I'll now take a look if there are any questions. Yes, we have a few questions, which I'll try to answer. No, there don't seem to be questions relating to my presentation. So that's it. So I'll hand back to Mark. Thank you very much.
Thanks, Mark. So I tend to rattle through this slide fairly quickly. It's what is ShareSoc and why should you join us? We're a non-for-profit membership organisation. We provide member services, but we also look to effectively police what's going on in the market and represent the interests of individual investors, and make noise if we see things that we don't like, and we don't have a sort of set of targets. We will look at the actions of governments, of the government, of regulators, of companies and brokers, and we'll make comments where we think they are inconsistent with the interests of individual investors. We do that with a voluntary board, unpaid board. We most of the hard work on that section is done by a combination of board members and volunteers. But we also have member services. On the information side, webinars, seminars, company visits, newsletters, blogs, AGM voting guidance and reports. Education side, we run masterclasses. There's an investor academy on our website. We have Signet, which is an opportunity to network in live groups or virtual groups with like-minded investors and self-learn effectively. Connections, so opportunities to network, online forums, seminars, and again, Signet. And we can provide you with some discounts on services that you use to assist your investment. So the whole thing is, the idea is that we improve your investing experience, and we promote both share and funding investing to individuals within the UK. Finally, a reminder on forthcoming ShareSoc events, Bankers Investment Trust. If anyone is not fed up with me talking, you can hear me present that one on 30th of January. Baker Steel, 6th Feb. A London seminar, hybrid, so you can come along to Regent's Park and enjoy 4 companies presenting, a glass of wine and a buffet, 11th of February. A Mastering the Market event from Stephen Clapham on 19th of Feb, and a post-budget inheritance tax and estate planning seminar on 26th of February. That's it from us today. I'd like to thank the audience, particularly the 62 odd that have managed to stay here until the very end, for your attendance today, and very much look forward to seeing you either as members or as participants in future ShareSoc webinars. In the meantime, get out there and vote. Many thanks. Bye.